The office was already half empty when he finally packed the framed certificate into a cardboard box. Most of the younger analysts had left months earlier, moving to other firms or entirely different industries. Their desks had been cleared quietly. The company issued monitors stacked along the wall like unused equipment from another era. His desk remained intact longer than most, steady and unchanged, the way his career had been for nearly 2 decades. He joined the company at 32, just after the birth of his first child. The offer had felt like stability in its purest form. The salary was modest but reliable. The health insurance was strong. There was a 401k match that looked generous compared to what he had before. The role wasn't glamorous, but it was structured. Defined responsibilities, predictable raises, a clear hierarchy. At the time, stability outweighed ambition. His wife had left her job the year their second child was born. Childcare costs in their area had surpassed their mortgage payment, and the numbers made the decision look logical. One income, tight but manageable. His income. In those early years, staying made sense. The company weathered the 2008 recession without layoffs. While neighbors lost homes and retirement accounts fell by half, his paycheck continued uninterrupted. He increased his 401k contributions gradually. He refinanced their mortgage once when rates dropped. They never missed a payment. Stability became part of his identity. By his early 40s, the market had changed around him. Recruiters began reaching out through professional networking platforms. Former colleagues posted promotions, new titles, relocation announcements. Salaries in his field were climbing faster than the incremental raises his company offered. He noticed the difference quietly. A peer who left for a competitor disclosed a compensation package nearly 30% higher. He calculated what that difference would mean over 10 years. The number was significant, enough to accelerate retirement savings, enough to pay down their mortgage early, enough to rebuild the college funds that had been paused during a medical emergency years earlier. He did not apply. The risks felt heavier than the math. A new company meant new expectations, potential relocation, probation periods, unfamiliar health insurance networks. His children were in middle school by then. They had friends, sports teams, routine. The house was finally comfortable. The kitchen had been renovated slowly over 5 years, paid in cash. At annual reviews, his manager praised consistency, reliable, steady, institutional knowledge, words that felt safe. Raises averaged 3%. Bonuses fluctuated but never surprised. Inflation, however, did not average 3%. The first time he noticed the gap was during a grocery trip. The total was higher than usual. Then property taxes rose after a county reassessment. Health insurance premiums increased 1 January without warning, even though coverage narrowed slightly. The company shifted more cost to employees as industry margins tightened. He compensated quietly. Contributions to the 529 plan slowed. Vacation plans shortened. A planned basement renovation was postponed indefinitely. Around that time, a younger colleague joined his department. Same degree, similar experience length if internships were counted. Starting salary 20% higher than what he was earning after 15 years. Market adjustment, HR explained. Industry demand had shifted. He absorbed the information without protest. Staying still had once protected him. Now it seemed to be eroding something more slowly. By his late 40s, his parents began requiring financial support. Prescription costs not covered by Medicare supplements. Home repairs they could not manage alone. Flights back and forth several times a year. None of it catastrophic. all of it cumulative. His emergency fund remained intact, but it stopped growing. Retirement contributions stayed consistent but did not increase. The mortgage balance declined steadily, yet so did his sense of flexibility. Opportunities continued to surface. Former co-workers invited him to informal interviews. Compensation discussions were transparent now. People spoke openly about salary ranges in ways they had not 20 years earlier. The gap between his pay and the broader market widened further. He updated his resume once, opened a blank document, listed his years of service. His responsibilities had expanded gradually, though his title had barely changed. He realized he had not quantified his impact in years. His expertise was deep but narrow, tailored specifically to internal systems that other firms did not use. He closed the document. The company restructured twice over the next 5 years. Each time, he survived the cuts. Severance packages were offered to others. He stayed. His tenure made him expensive relative to new hires, but not expensive enough to eliminate. He trained younger staff members who arrived at higher starting salaries than he had ever earned. His 401k balance looked respectable on paper. 2 decades of steady contributions had compounded reasonably well during bull markets. But when he ran projections, assuming retirement at 65, the numbers did not offer margin. They offered adequacy. Adequacy began to feel different from security. At 52, the company froze pension accruals for legacy employees. He had been hired just late enough that his pension portion was modest to begin with. The freeze reduced future growth further. Management framed it as necessary for competitiveness. Shareholders approved. That year, his property insurance premiums jumped significantly after severe storms hit neighboring counties. The insurer cited regional risk adjustments. He shopped for alternatives but found similar pricing across providers. Climate risk, once an abstract topic, appeared as a line item in his annual escrow statement. His salary increase that year was 2.5%. The realization did not arrive dramatically. It formed gradually during routine tasks. Logging into the payroll portal, reviewing health benefit elections, comparing college tuition estimates for his oldest child against the 529 balance. The stable job had provided continuity. It had also anchored him to a compensation structure that did not keep pace with the broader market. Over 20 years, the cumulative difference amounted to several $100,000 in unrealized earnings. He began to calculate differently, not in terms of risk versus safety, but in terms of opportunity cost already absorbed. When his oldest left for college, tuition exceeded initial projections by a wide margin. Scholarships covered part. Federal loans covered another portion. The remaining balance required monthly payments from current income. His wife returned to part-time work to offset some expenses. It helped, though not significantly. The house was nearly paid off by then. That milestone, once symbolic, felt muted. Equity existed on paper. Selling would mean leaving the neighborhood they had known for decades. Property values had risen, but so had prices everywhere else. He attended his 25th work anniversary luncheon in a conference room with catered sandwiches. A plaque was presented. Applause was polite. Many of the faces in the room had not been there 5 years earlier. Later that afternoon, he reviewed internal job postings. Most leadership roles required experience with technologies he had not used. The company had evolved around him. He remained dependable, but not strategic. He finally applied externally at 54. The interviews were cordial but cautious. Employers valued his longevity, but questioned adaptability. Compensation offers were modestly higher than his current salary, not dramatically so. Starting over at that stage carried its own risks. Vesting schedules reset, seniority lost, new probation periods introduced. He stayed. The final restructuring arrived 2 years later. This time, tenure did not protect him. The department consolidated with another region. His role was eliminated with a severance package equal to 6 months of pay and extended health coverage for the same period. He was 56. The severance deposit appeared in his checking account like a temporary cushion. He updated his resume again, this time fully. He contacted recruiters who had once reached out regularly but had since moved on. Interviews were fewer now. Some roles paid significantly less than his previous salary. Others were contract based without benefits. He accepted a position after 8 months of searching. The pay was lower, the commute longer, health insurance premiums higher. There was no pension component at all. The gap between where he might have been and where he stood was no longer theoretical. It was embedded in his retirement projections. Social Security estimates showed one figure. His 401k balance showed another. The two combined suggested a retirement that required careful budgeting rather than flexibility. He did not regret the years of stability during recessions. Those years had protected his family from visible disruption. They had kept the mortgage current. They had funded braces, summer camps, medical procedures, and reliable vehicles. But the cost of remaining in place had compounded quietly. His children graduated with manageable but real student loan balances. His wife continued part-time work longer than originally planned. Retirement shifted from 62 to 67 in his spreadsheets. When he drives past his former office building now, the signage has changed. The company was acquired by a larger firm. The logo he had known for decades no longer hangs above the entrance. Many of the younger employees who left earlier advanced into senior roles elsewhere. His frame certificate sits in a storage box in the basement behind holiday decorations and old tax returns. The mortgage is finally paid. Property taxes remain. Insurance premiums remain. Healthcare costs continue to rise annually. His income today is steady again, though at a different level. The routine has returned, but the arc feels narrower. The years when switching would have meaningfully altered long-term earnings are behind him. The realization did not arrive as a single moment of clarity. It accumulated through pay stubs, benefit elections, and market comparisons he chose not to act on. The stable job had once been the responsible choice. Over time, responsibility and momentum separated. He continues to work. Contributions to retirement accounts resume at a slower rate. Projections update each year. Numbers shift slightly, rarely dramatically. The certificate remains in the box. The office remains somewhere else, occupied by people whose names he does not know. The career that felt permanent proved transitional after all. He locks his car in the new company's parking lot each morning, walks past a different set of glass doors, and signs into a different system. The stability he once protected now exists in a smaller frame. The long-term consequence is not visible from the outside. It appears as an ordinary career, a steady employee, a paid-off house, a retirement date penciled in later than expected. The accumulation of years in one place left its mark in numbers that do not announce themselves, only persist. He keeps working,